Hello everyone, and welcome back to Explain the Charts, your go-to channel for in-depth market analysis. Today is November 12th, 2025, and we are diving deep into the chaotic price action of Bitcoin. There is a ton of news driving volatility, so first we'll cover the major headlines, and then we'll break down what the charts are telling us. The biggest macro news is the end of the 41-day U.S. government shutdown, with the Senate passing a funding bill. This is generally seen as a positive for risk assets like crypto, as it removes a major piece of economic uncertainty. Adding fuel to the fire, President Trump has announced plans for a $2,000 tariff dividend for Americans, which the market is interpreting as a fresh liquidity injection, similar to the stimulus checks of 2020. Many analysts believe this could ignite a new bull run as more money flows into the system. However, the market's reaction has been mixed. We saw Bitcoin briefly reclaim $106,000 on this news, but it has since pulled back, with headlines from Bitcoin Magazine noting a crash towards $102,000. This suggests that while the macro environment is improving, there's significant selling pressure preventing a clean breakout. Other bullish developments include payment processor Square launching a new Bitcoin payment feature and famed short seller James Chanos closing his short position on MicroStrategy, which is a huge corporate holder of Bitcoin. On the other hand, we have some geopolitical noise, with China accusing the U.S. of orchestrating a massive $13 billion Bitcoin hack, which adds a layer of uncertainty. Overall, the news gives us a bullish macro bias due to liquidity prospects, but the immediate price action is showing signs of weakness and indecision. Now, let's see how all of this is reflected in the charts. Here on the daily chart, we can see the bigger picture of Bitcoin's journey over the past several months. We had a powerful uptrend that began in late summer, pushing the price to a recent peak well above $110,000. As the news highlighted, we then experienced a significant derivatives-linked crash in late October, which brought us down to a very important support area. That floor was established right around the $99,000 to $101,000 zone, which has proven to be a very strong demand area. We can see the price bounced hard off that level. Now let's zoom in on the last several weeks to get a clearer view of this recent action. This filtered view shows the October drop and the subsequent V-shaped recovery attempt very clearly. The strong green candle on November 10th, posting a gain of over 4.8%, aligns perfectly with the news of the government reopening and stimulus talks. That was a day of pure optimism where the market priced in the good news. However, look at the very next candle for November 11th. It's a large red candle that completely erased the previous day's gains, showing a strong rejection from the $107,000 area. This confirms reports of whale selling and shows that bears are aggressively defending these higher levels. The price has failed to hold the $105,000 to $107,000 range, which previously acted as consolidation and is now acting as resistance. This is a classic example of previous support flipping to resistance, a bearish short-term signal. The bull's main accomplishment here is holding the line above the critical $99,000 support floor. As long as we remain above that level, the larger bullish structure remains intact, albeit weakened. The primary battle is now for control of the range between roughly $102,000 and $107,000. The next key upside resistance levels to watch, according to technical analysis, are around $109,400 and the more significant barrier near $111,000. A decisive break above $111,000 would invalidate the recent bearish price action and put bulls back in firm control. On the flip side, a breakdown below $99,000 would be a major victory for the bears, with the next significant support levels cited by analysts sitting near $96,000 and even as low as $93,000. Now let's switch to a much shorter time frame to see how this battle has been playing out hour by hour. Switching to the 15-minute chart, we are looking at the price action from the last day. This gives us a granular view of the sell-off on November 11th. We can see the price was trading comfortably above $106,000 before a sharp wave of selling began. The price then cascaded downwards, breaking through multiple small support levels. Notice the series of lower highs and lower lows, which is the definition of a short-term downtrend. There was an attempt to find support around the $104,500 level, but it failed to hold for long. The selling pressure intensified, pushing the price all the way down below $103,000. In the final hours of the trading day, we can see the price trying to establish a new support base around the $102,500 to $103,000 area. There is a lot of volatility and indecision here. Short-term traders will be watching this range very closely. A bounce from this level would need to reclaim $104,000 to show any real strength. Conversely, a failure to hold this area could lead to another quick leg down towards that major psychological level of $100,000. This short-term chart really illustrates the current bearish momentum following the rejection from the highs. It highlights that despite the positive macro news, the market is currently in sell the rally mode. So let's bring it all together with a final summary. Alright, to recap everything we've discussed, let's review the key levels on the daily chart one last time. Your most critical support zone is between $99,000 and $101,000. This is the line in the sand for the bulls. If that breaks, look for potential targets at $96,000 and $93,000. To the upside, immediate resistance is the zone we just lost, from $105,000 to $107,000. Bulls need to reclaim and hold this area to regain momentum. Above that, the next major resistance cluster is at $109,000 to $111,000. The ultimate bullish target in the medium term is a break above the $116,000 to $117,000 resistance, which could open the path toward $129,000. So, what are the likely scenarios? The bullish scenario, which I'd place at about a 65% probability, is that the strong macro news will eventually win out. In this case, Bitcoin will likely consolidate in this $102,000 to $105,000 range for a bit before making another attempt to break higher. This scenario is reinforced if we see a slowdown in selling pressure and a firm hold above $102,000. The bearish scenario, with about a 35% probability, would see this recent rejection as the start of a deeper correction. If we fail to reclaim $105,000 soon and instead break below the current short-term support, we could see a swift retest of the major $99,000 support. A break of that level would heavily reinforce this bearish outlook. Things to watch for in the coming days are ETF flow data, which has seen recent outflows, and any concrete developments on the stimulus checks. Of course, pay close attention to how the price reacts at these key support and resistance levels we've outlined. That's all for today's analysis on Explain the Charts. If you found this breakdown helpful, please hit the like button, subscribe to the channel, and let me know your thoughts in the comments below. Before you go, please remember this is not financial advice. All of the information provided in this video is for educational and entertainment purposes only. Always do your own research and make investment decisions based on your own unique financial situation.